So we are already in the middle of a conference that tries to understand the evolution of sustainability standards and maybe potential requirements or criteria that we might ask them to obey or to have. And we are very happy to welcome you from the Wharton School. It's early morning in the US, so thank you for joining us in the morning. Robert Stambaugh is the Miller Anderson and Shared Professor of Finance at the Wharton School, University of Pennsylvania. He's one of the best-known finance professors in the world, and in particular in his field, asset pricing, he has set standards and I would say seminal papers and everybody knows him, I would say, in this field. But nevertheless, since this is a mixed audience, so we have not only finance experts, but also people from other disciplines, also from the sciences, I want to say a few words about you before handing the floor over to you. So Professor Stambaugh, as I said, is at the Wharton School. He has been a president of the American Finance Association, is a fellow of that right now, and active in basically all the professional associations that we know and that matter. He has been editing the Journal of Finance, which is our most important journal in the field, but also he was editor or associate editor of all other major journals in the field. And that is because, as I said, in the field of asset pricing, he has set standards and contributed many important observations. So he was really working about the question whether returns are predictable. So what can we learn from past prices as to future prices. In general, he has worked on models of asset pricing, so what drives asset prices, and I think this makes him the ideal person to talk about the relationship between green investment strategies and returns. So that has been an issue and is an issue for many investors. And many companies nowadays actually advertise particular tailored portfolios that are expected to have certain properties or certain return properties. And I think it would be good in this conference to basically touch ground on this issue and not only alluding to it in a rather general framework, but getting to real research and findings. And for that reason, Bob Stambaugh will give a lecture on Dissecting Green Returns. This is also the title of a much cited very recent paper of his together with co-authors, and I think he will speak about it. Bob, thank you for delivering this speech, and we have agreed that you talk about 20 minutes, more or less, and afterwards we can take questions, and I will invite everybody to take note so that you have a good question at hand when I point at you later on. But for the time being, I hand over to Bob, and the floor is yours.
Hey, thank you very much, John. If they could put my slides up, there they are. Thank you very much. So it's a pleasure to speak to you all today. I've just had breakfast. You just had lunch, so we're a little bit off on the day's clock. But I'm very much looking forward to getting your comments and hearing your questions. As Jan said, I'll probably try to speak here for about 20 minutes and use the rest of the time for questions. This is joint work with Lou Bush-Pastor and Luke Taylor, you start with a question that I think many people have asked in recent years, and that is, should one expect superior performance from sustainable investing? And when you survey investors, they often say yes. We cite various surveys done by BlackRock and BNP Paribas and Schroders, for example. When you ask asset managers, they often say yes. So for example, BlackRock has said that integrating sustainability can help investors build more resilient portfolios and achieve better long-term risk-adjusted returns. State Street says ESG is a source of alpha that leads to positive portfolio performance. And in fact, when you look at academic studies that have looked at the performance of sustainable investing, that evidence seemingly says yes as well. We cite a number of papers here. that regard. Our answer to this question is no. We say no. Sustainable investors, sustainable assets have lower expected returns. First of all, the theory would say so. For example, we have a paper that came out last year in the JFE where we explain why if investors get some sort of extra utility, what we often call warm glow from holding green assets, and at the same time they get some degree of anguish from holding brown assets, the equilibrium expected returns are going to be such that green assets are then going to have higher prices and lower expected returns. And then there's another source of lower expected returns on green assets, and that is that they provide a hedge against climate risk, against unfavorable climate news. Green assets are going to tend to outperform in the face of that, consistent with empirical evidence, by the way. And one often hears that, well, but sustainable or green firms are likely to be more profitable going forward as we transition to a greener economy. But of course, in an efficient market, any such superior expected profits of firms are already priced in. So that's not going to be a source of high expected returns going forward. So our evidence in this paper is that indeed, in the past, the green returns have had higher returns than brown stocks, but we also estimate that they have lower expected returns than brown stocks. And the wedge here between the realized and the expected, we attribute largely to the fact that in recent decade, climate concerns increased in an unanticipated fashion, and that led to the higher realized green returns in the past. And when climate concerns increase, you get really two channels operating on realized returns for assets. First of all, you get a channel that comes through customer demands, that is, demands for the goods and services produced by firms. And when climate concerns increase, you get increased expectations of things of sales like electronic vehicles and the like in the future, and that of course boosts the price of firms that would sell such products. Think of Tesla, for example, as one shining example of that in recent years. And then there's also another channel, which is that as climate concerns increase, investors' taste or utility they get from simply holding green assets, the enjoyment they get, or at the same time the anguish they get from holding stocks they see as browner, that effect increases, which also then drives up the price of green stocks and produces high realized returns at the point that happens. But this past performance should not be viewed as indicating high future performance. This is the usual caution that all asset managers are required to sort of advise their clients of, that past performance is no guarantee of future performance. But we think in the case of green returns, this is a particularly important and salient message. One example we cite of this wedge between expected returns and realized returns actually comes from an example that many of you are probably more familiar with than I, which is the German government has been issuing since 2020 so-called green bonds to finance, the proceeds of which are earmarked to finance certain sustainable projects as the government transitions to and the economy transitions to greener energy and so forth. And each of these bonds has essentially a twin or a conventional twin that has essentially the same maturity date, same issuer, same coupon rate, and coupon payment dates, and so forth. So you get basically an opportunity to compare these two bonds and see the effect of this designation of greenness. And what we find is that well, since these bonds were issued, this is the 10-year bond that was first issued back in September of 2020, and we plot here the yields on the the twin bond, the dash line, the conventional versus the green bond. You can see that really throughout this history, the green bonds have sold at higher prices, that is lower yields. If we look at the realized returns on the green bond versus the conventional bond, if you have bought the green bond and shorted the conventional twin, you would have actually made money. You had a positive return. Why? Well, because the spread in the yields actually widened. This yield spread, which we call the greenium, actually widened during this sample period. But of course, this higher realized return on the green bond should not be interpreted as higher expected returns going forward, because of course for bonds we can directly observe a yield and see that the yields on the green bonds are in fact lower, so they would be offering lower expected returns for any investor certainly holding these bonds in the future, particularly through maturity. Now, with equities, we can't do a simple comparison. We can't observe expected returns or something like a yield to maturity as cleanly as we can with bonds. Most of our study deals with equities. So I'll tell you about how we're going to come at this problem. But I'll sort of say that green stocks, as we're going to define them, did have high realized returns in the past decade. In fact, the spread between returns on green versus brown was 65 basis points a month, and a very statistically significant spread with a t-stat of over 3. However, we believe that with green stocks have lower expected returns, or had lower expected returns during that period, and we can estimate expected returns in either of two ways. One is sort of an ex ante way, using so-called implied cost of capital, and the other is looking at ex post returns, where we net out shocks to climate concern and earnings. And one other result that we find is that, in fact, the outperformance of green stocks over the past decade explains a lot of the historic underperformance of value. In fact, the well-known value growth spread, the HML spread, if I'm in French, had really historically bad performance in the 2010s. It's really its worst decade ever. And we find that this difference between green and brown stocks, in fact, it's a factor that we construct called the green factor, explains a lot of that underperformance. And the reason is simply that value stocks tended to be brown, so-called brown stocks, and growth stocks tended to be green. So the green stock outperformance actually sort of flowed through to a value and growth spread as well. One other thing we discover in the course of this project is also that smaller stocks seem to exhibit some delayed reaction to the climate news, and I can show you that evidence a bit later. So first of all, how do we measure stocks greenness? Because there are a lot of ways to do that, of course. Well, we settle on using MSCI ratings. MSCI is really the world's largest ESG data provider. If you measure sort of their client base, for example. They provide a bunch of different inputs to their overall ratings. We sort of pick out two key elements of their ratings. One is in terms of environmental ratings, an environmental score, which is called an environmental pillar score, which really measures a company's resilience to long-term environmental risks. And it's a weighted average across like over a dozen different issues that relate to the environment. And then there's also what we call an E-weight, which is really about measuring the importance of environment relative to social and governance issues for that industry. So it brings in sort of an industry factor. So for example, you can have two companies with the same E-scores, like ExxonMobil and Best Buy, where their E-weights are very different. So ExxonMobil would come out with essentially being a rather brown stock, whereas Best Buy under our construction would end up being much less so. And we're then going to take these so-called greenness measures and just subtract the evaluated average of them across firms. So in other words, the evaluated greenness across all firms in the market will be 0 by construction. And if you look at the industries where we rank by these environmental scores we construct, you can see that, not surprisingly, it's sort of at the bottom of the list with so-called brownest industries. We see things like chemicals and oil and gas and steel and so forth. Interestingly, asset management is the greenest in terms of this kind of ranking. MSCI's coverage of firms greatly increased in around November 2012. So our main sample period starts then, and then we extend that through well up to the end of our return period, or later on we have to truncate this period at the end a bit due to the availability of the climate news measure that we're going to examine. One of the things we construct here is just a simple return spread between green stocks and brown stocks. So we just take the top third and bottom third of stocks, value weight each leg, and look at a spread. So here you can see the green return versus the brown return. This is that 65 basis points a month difference that I talked about earlier. So you can see dramatic sort of outperformance of green stocks in the previous decade. And in fact, this outperformance is quite resistant to trying to control for any kind of well-known asset pricing factors. So you can see here in the first row, the constant, or so-called alpha, survives controlling for a variety of different asset return factors, it's always remains economically and statistically significant. So I mentioned the greenium earlier for in the German green bond example. We also sort of take that same terminology and transfer it to equities. We call it the equity greenium, which is simply the expected difference in returns between green and brown stocks. And just for concreteness here, we'll think of this as the expected return between these value weighted green and brown legs that I just showed you. The first way we come about trying to estimate the expected difference there in returns, or estimate the equity greenium, is to use implied cost of capital, which have been used in previous studies for a variety of purposes. This is essentially for each stock, the discount rate that equates the stock's market value to the present value of its expected future cash flows. And we follow closely the approach of the work of Ho, Van Dyke, and Zhang here, which builds on classic earlier work of Gebhardt, Lee, and Swaminathan. One of the key elements of this approach is to replace analysts' earnings forecasts with regression-based forecasts. So, for example, one thing this allows you to do is make use of companies that have, for analysts, negative forecasted earnings. Where in the regression-based approach, you can get a lot more companies in the sample. And this paper by Lee, So, and Wang in 2021 actually says this approach is the most precise ICC approach among a variety of ones they studied. So what we get when we look at implied cost of capital, and of course you compute this at every point in the sample, we always get that the implied cost of capital of green stocks is lower than brown stocks. So this equity greenium, just like for the greenium in the German green bond market, it's always been negative, and in fact you can see that it's sort of wandered around, but in the last 4 years or so of the sample, it's exhibited kind of a downward trend, much like the German greenium in the bond market. Now, the other way that we infer the equity greenium is to look at returns ex post. And of course, when you look at ex post returns, the most popular way to estimate expected return from ex post returns is to compute the sample average return. We don't do that. Actually, what we do is recognize that if you've got some other variable, we'll call it X, that's correlated with returns, and it has a zero mean. For example, take unanticipated climate shocks. You can get a sort of a better estimate. You can sort of net out the unanticipated effects that are due to this X realizations by looking instead at the intercept in a regression of returns on that X variable. We'll call this A hat. So that's our estimate of expected return using ex post realizations. And what we put in X are two things really. One is a measure of shocks to climate concerns, and the other are earnings surprises. Okay? For the climate concerns, we rely on a recent paper by Ardia et al. That looks at 8 different major U.S. newspapers and constructs an aggregate index of sort of negativity and risk focus on climate issues. We then take their series and fit an AR1 process to it using the most recent 36 months of data, and take the 1 step forward, or 1 month forward prediction error coming from that moving AR fit to get our climate concern shock for each month. And here you can see we plot on 2 different scales here, left and right, but you can just see that the path here of climate concern shocks exhibits a fairly significant degree of association with this green minus brown or GMB return that I showed you earlier. That's the blue. The red is the climate concerns. I mentioned that 2012 was when MSCI greatly expanded their sample. If we take a period prior to that, where they had much smaller coverage of stocks and nevertheless construct a green minus brown return spread, we actually see that's that faint dotted line in the slide, that there's kind of a similar mimicking V shape or U shape in the climate concern index and this cumulative green minus brown return. But as I say, that's based on a much smaller sample of stocks. So we focus our primary analysis post September 2012. Then the other thing we do, we put in this X, the thing we control for our earnings surprises. So there we look at 2 measures. We look at sort of a 3-day window of earnings announcement returns, and also a change in analyst long-term earnings forecast. So we put a monthly value of each of those things in. And you can see that whether or not we include the earnings shocks, the monthly GMB performance is significantly positively related to the change in climate concerns. So when climate concerns increase in a month, we get on average the green minus brown return being higher. In fact, when we put in the earnings surprises, the R squared almost doubles, but the climate concern shocks remain statistically important. Also, if we control for the Fama French factors, look at so-called GMB alphas, where we subtract a market and size and value factors, the importance of climate concerns remains. And you can think of the intercept here as ultimately as I said, that's that A hat. That's the estimate of the equity greenium once we net out the effects of climate concern shocks and earnings shocks. And you can see that once we do that, we again get negative numbers, quite different, of course, from the 65 basis positive performance that we get before we net anything out, that as I showed you earlier. And here just is a sort of a graphical picture of that, where we can go actually month by month and construct this so-called counterfactual, where we subtract out the effect of climate and earnings shocks. And you can see that basically the overall trend in that counterfactual is essentially that alpha hat, our estimate of the expected return. And you can see that once we do that, we get expected returns being modestly negative, as opposed to the sharply positive realized performance. And here again, it's the same picture. Once we net out the Fama French factors, it actually brings that A hat even slightly more negative. Now we also, in addition to just looking at portfolios, where we rank by green and brown and form these value-weighted portfolios, we also look at a cross-sectional regression, a panel regression, where we use individual stocks. So here, if you just put greenness in the regression, you get a significantly positive association with the stock's greenness. Again, just replicating this finding that green stocks outperform brown and in our sample period. But again, once we control for climate shocks, that is interacting greenness with changes in climate, the effect of greenness goes away, or in fact reverses once we include the earnings surprises. And here we get this first indication that it's really the climate shock of a month ago that becomes more important once we look at the individual stock level. This is evidence that there's some delayed reaction for the typical stock to climate news. Whereas with the GMB, we're evaluating things. Of course, when you evaluate, the big stocks dominate. But here, when you do things with an individual stock level, you can see that this evidence of delayed reaction to climate comes through. And we can sort of get a somewhat more precise picture of that delayed reaction. We actually look at things on a week-by-week basis, where we take a green minus brown return spread based on just large stocks. I do the same thing we did earlier with constructing a green minus brown, but do so only with the top third of market cap stocks. And then do the same thing for stocks in the bottom third, and you get therefore a sort of a spread between spreads, sort of a difference in difference thing. And you can see that the relation of that with the climate concern change measure on a week-to-week basis is actually stronger for large stocks in the current and most recent week. And then you can see for the smaller stocks, it becomes stronger in the third, fourth week out. So there does seem to be some delayed reaction. Of course, it's there's plenty of evidence of some degree of underreaction in small stocks in particular, in other aspects of asset pricing. And so in some sense, this isn't a huge surprise that there might be such a thing, but kind of interesting that it shows up for climate concern shocks as well. As I said, we also construct a green factor that's really a theoretical prediction coming from our earlier JFE paper, which is essentially another way of doing long green, short brown, where you instead weight by greenness and not market cap. And as we in that paper explained, the expected performance of that factor should be negative ex ante. We scale the factor to have the same volatility as the green minus brown spread, and you can see it tracks it pretty closely once we do that. And when we use that green factor in just a two-factor model, the market and the green factor as a second factor, you can see that this rather large, 71 basis point underperformance of value during the sample period is greatly reduced once we control for the green factor. In other words, the value spread loads very strongly negatively on the green factor and accounts for a lot of the sort of negative market alpha that value spread has. And in fact, it really takes away pretty much all of momentum during the same period as well, because again, recent winners tended to be green as opposed to brown. So once you control for the green factor, you again get momentum profits having pretty much vanished over that same period. So in conclusion here, I said I just about a minute or two over my allotted 20 minutes. I think again, the realized returns were higher than expected returns during the last decade due to climate concern shocks largely. And our estimates of expected returns give a very different picture. Again, repeating this warning that past performance should not be viewed as an indication of future performance, and that the somewhat puzzling historic underperformance of value stocks in the last decade can perhaps be somewhat understood by bringing in the performance of green stocks over that same period. So I will stop here and happy to take any questions at this point.
Yeah, so thank you, Robert. So it was of course a finance paper, so not everybody is familiar with these terms and presentations, but maybe we take immediately questions. But let me ask one question to start with. So what in your opinion is the lesson that the community, so to speak, can take from your study as far as intended consequences of green investment is concerned? So can green investors or investment management that convinces people to construct green portfolios, to invest in green portfolios, can that change the world, or can that make a difference? Is that something that can be, let's say, derived from your results?
I don't think our results speak directly to what kind of impact green investing can have on firms. I do think that one message it would send to asset managers is that if you're trying to convince investors to invest in green stocks because they have higher return performance, that the ability to do that may be somewhat limited, and that in the future, if expected returns are in fact lower on green stocks, we would anticipate that eventually those lower expected returns will be borne out in lower realized returns. So, rather than trying to market green investing as a way to make more money, our prediction would be that at some point the marketing will have to change in such a way that you attract investors through their desire to, in some sense, do good, right? But the message really from our previous paper in the Journal of Financial Economics was that if enough investors decide that they want to weight their portfolios toward green stocks and away from brown stocks, that in equilibrium, that will have an impact on the cost of capital of firms, that the prices of their stocks, and thereby can affect investment policies of firms through that cost of capital channel. But it would seem we would need substantially more of such investment than we currently have these days, because as we point out, and others have pointed out, when the fraction of money that's being reallocated based on greenness is relatively small, which it certainly appears to be, say, in the U.S. still, then the implied impact on cost of capital is also going to be very modest. So the potential for impact is certainly, I think, present. At least theoretically, it should make a difference as you get much bigger pieces of money being moved around and thereby affecting asset prices. But I think the message of the current paper would be that if you're trying to get the money moved around by attracting investors via higher returns, that may be doing some injustice to the record.
Okay, so thank you. So I have a few hands. So I start Lucrezia, then Patrick, and I go this way. Look, so we start here, yes.
Well, thank you for a very interesting presentation. I had read your previous work, and I'm really happy that there is some empirics now, so that, and I'm not doing research in this area, but I've been, in this conference, we have been discussing about standards. So I think your result is potentially important, because the more the industries will have to comply with standards, the implication would be that we'll have much more green investment, and scale matters, so that there will be an influence on cost of capital, which is something that there was a big question mark until recently, okay? So that does this green finance really matters? I interpret your result by saying it potentially does, okay, if it becomes big enough.
Yeah, I think that's right. And remember, there are different channels through which these green standards or sort of characterizations of green can matter. One is the investor channel, but the other would also be the product demand channel, right? So if you have ways of identifying green and brown firms that not only investors care about, but that market participants in product and goods and services markets care about, then that can also affect firms' stock prices through that channel, right? Because it impacts their revenues. So I think the role of standards could not just be through the investment channel, but it can also, I think, help, because after all, what are standards trying to do here? In some senses, affect some degree of coordination, right? I mean, I assume that the idea here with standards in general is to spur coordination, and the coordination can occur at the level of investing, right? Investors can coordinate on a set of standards, and thereby, if they care about impact, they can increase their impact through that coordination. But the same standards could potentially spur, in some sense, coordination in goods and services markets by consumers, right? And that has an impact on stocks prices, and also then presumably also on the actions of management of the firms, the stocks being priced that way.
Yeah, that would be somehow the indirect effect on the numerator of the present value formula, right? While your paper is about the denominator, right? How does the discount rate change?
Well, I don't know if our paper is so much directly about the denominator, because as we point out, these high realized returns that we've seen could very well have been largely driven by the numerator, by the the changes in expected future cash flows. In terms of the ESG investing effect, right, the effect that investors have on stock prices by their reallocation in their portfolios, yes, that would indeed be the denominator effect.
Mm-hmm. Yeah, thank you.
Yeah.
Patrick?
Thank you. I was wondering, can we perhaps flip the question around and say, if you were addressing not the investors, but the issuers. This morning we were spending a lot of time with, standards, very hard to meet, extra expenses. Would a consequence of your work be that if you are an issuer, the cost of proving your greenness will in fact, at least for the moment, result in a higher stock price? But there I'm wondering about your conclusion that the effect on the cost of capital is minimal. I don't quite see how those two work together. Thank you.
Sure, yeah, so the effect of improving your greenness or convincing investors and consumers that you're greener is only going to matter for your stock price if you convince enough of them, right? So that's the idea that if standards actually facilitate coordination among investors, so that as an issuer, if you think, these standards have made it easier for investors and consumers to coordinate, in the sense that if I don't produce green products, my stock price is not going to be high for two reasons. Investors are not going to want to buy my stock because they don't like holding firms that aren't green, and consumers won't buy my products or services because they don't like buying products and services of things that aren't green. If standards allow investors and consumers to coordinate more on that scale, and then as an issuer, I understand that's going to be the effect of standards, is that it facilitates and promotes that higher degree of coordination, then I'll care, right? But the point about it having a small effect is that if on net, for one reason or another, we don't have a lot of change in the way investors behave or change in the way consumers behave, right? If it's only a small number of investors who reallocate their portfolios to tilt toward green and divest from brown, or similarly for consumers, if it's only a small number who buy products of green firms and shun those of brown, then of course the effects on stock prices will be minimal, despite standards. But I think the way an issuer would view standards is just that I think they create a bigger potential for the kind of coordination and the larger amount of investor and consumer action that could result.
So, Tatjana, you have something from the chat. Yeah.
Yes, thank you, Jan. So, some questions from Lynn Johansson. So, her understanding is that most of the ratings are focused on the effect of the environment on organization, portfolio assets, projects, or activity, but not the impact that this have on the environment. Hence, they are seen to be misleading and are being seen as greenwashing. Can you comment on this? She also asks if you think that the Glasgow Financial Alliance for Net Zero will have a positive effect to shift investors to do good.
Yeah, I mean, I think that the greenness ratings that we use from MSCI combine a bunch of different dimensions of environmental impact. You know, not just, for example, carbon emissions, but like I said, over a dozen different environmental issues. So I can't, beyond that, I really can't comment on the appropriateness of these environmental scores. We sort of take their set of issues as the ones that are deemed important for the environment. I mean, one thing we do notice, though, is that there's at least for the realized returns that we observed in our sample period, is that the industry, overall industry greenness has a big impact on the performance that we observed. So we also do a version of our green minus brown returns where we industry adjust, you know, take a stock and just ask how green or brown is within its industry. And we find that industry adjusted greenness has much less of an important role in explaining differences in returns. The sort of overall industry level environmental score seems to play a significant role in the green minus brown, which I think also speaks to some of the different ratings out there. Some of these ratings, as we've looked at them, seem to be, at least to our eyes, more industry adjusted. And one thing we liked about the MSCI ratings, reason we sort of focused on them, is because it did allow us to drill down and incorporate sort of industry level effects as well, and in fact, you know, thereby distinguish between those and within industry effects.
Yeah, thank you. So a last question from Christoph Meinert.
Yeah, I'm wondering whether, so we're all, or mostly economists in this room here, I wonder whether the familiar notion of demand and supply can help us getting things straight here. So one of the previous questions, I think, was pointing in that direction, right? So my interpretation is what we've seen in the past years in that market is the effect of a huge demand shock, right? So the demand for these green assets has been increasing a lot, right? And then that's exactly what you see, right? You see these huge realized returns because there's a lot of money seeking proper investments. And now this whole field is very dynamic. And I wonder how you see this going forward if the supply of green investments is at some point catching up, right? So that's exactly the purpose of this whole conference here, right? So once we have sustainability standards in place, I think that will also give another boost to the supply of green or sustainable investments. And then the question is how this then shapes the market here, right? Because typically in standard asset pricing applications, we think of the supply of risky assets also as fixed, right? But that's not the case here. I mean, there's much going on in the market at the moment, and I wonder how you see this going forward.
Yeah, that may be the concluding response then.
Yeah, that's interesting. I think an interesting question, that there could be a supply response, right? I mean, you know, we all know that in the short run, for example, if more people like to drive white cars than black cars, that could drive the price of white cars up temporarily, but of course, ultimately, they'll just produce more white cars, and white cars and black cars will cost the same, but they cost the same to produce. And you can, in principle, find the same thing with green stocks, but I think a lot of this hinges on what it means to be green. So for example, in our previous JFE paper, as I say, we always had the value-weighted greenness being zero across stocks. So, for example, with investors, the satisfaction or the anguish they get is in holding stocks that are green or brown in some sense and relative to the market, right? So, if firms become greener overall, the question is, how does that affect the utility that investors get? Are they still going to get more utility out of holding the stocks that are relatively greener than others? Because there'll always be a distribution, right? There'll always be some stocks that are relatively brown than others, if there's still a warm glow utility that you get from holding the greenest and an anguish you get from holding the brownest, even though overall, the greenness has gone up. then it becomes less clear as to whether these expected return differences would essentially converge to zero, right? And I don't think we know the answer to that really. But I think to some extent the answer to your question could hinge on that, as in some sense, you know, what would be the investor's response to an overall level of increased greenness in firms, as long as there are always still some firms that are a lot greener than others.
Yeah, and then there's also the cash flow effect, right? That also might come into play.
That's right. Everything I say about investors could also be, you can repeat for consumers and the demand for products. Yeah.
Okay, so thank you very much, Bob, for your insights and for the talk. So our time is over, and we basically, of course, you are more than welcome to stay on for the conference and ask questions. But if you are not, or even if you do, we want to thank you for your contribution. And I conclude this session. We have a short break for a coffee, and we start in 10 minutes. Right. So.
Thank you all. Thank you all.